So as far as I'm concerned, generative AI, or AI in general, is basically the code word for riches. So over the past 18 months or so, if you were to track down the number of mentions of artificial intelligence on corporate earnings call, we can see an extremely strong correlation between the stock price and the number of AI mentions. Don't believe me? As of the time of this recording, the S&P is up roughly 15 to 16% on a year-to-date basis. Going down the list of the top 9 companies by market capitalization in the S&P and their year-to-date performance. Microsoft, 23%, Apple, 16%, Nvidia, 158%, Google, 32%, Amazon, 31%, Meta, 45%, Berkshire, 11%, Broadcom, 51%, and Tesla, flat on a year-to-date basis. Now, we finally know why Tesla and Berkshire did not outperform the market index. Simply put, because they did not mention AI enough in their earnings call. We have finally found the stock market secret. Jokes aside, we know that this might potentially be one of the contributing factors. But please take this correlation analysis with a grain of salt. So like many investors, we are equally excited about the new paradigm shift brought about by this AI wave. In fact, nearly a year ago, Piranha Profits held our live online event, the 6th Wave, outlining the investment opportunities back then. So for those of you who have taken advantage and bought into those stocks, congrats! But for those of you who have missed it, don't worry. Adam Khoo will be sharing his real-time insights on how he intends to play this AI wave moving forward, and also share how he's positioning his portfolio to take advantage of the different hidden opportunities in today's raging bull market. So tickets are free, spots are limited, so head down to the link below to get your seats now. Back to the video. Considering that the market has enjoyed an incredible run over the past 18 months, some investors are starting to be skeptical about how sustainable this bull market is. So if we were to put momentum aside, because sometimes stocks can become more and more overvalued, which inevitably results in bubbles being formed. But as long-term investors, we are probably more interested in the company's fundamentals and whether the growth of the underlying business is sound, logical, and more importantly, sustainable, rather than a one-off phenomenon, of which some might be wary of, especially with this recent boom in interest around this entire idea of generative AI. So just in time, Goldman Sachs have recently published a research report attempting to answer this trillion-dollar question. Is there too much spend and too little benefits from this Gen AI investment cycle? So the report starts off with an interesting question. Tech giants and beyond are set to spend over $1 trillion on AI capital expenditure in coming years, with so far very little to show. So will this large spend ever pay off? What do you think? We look forward to seeing your answers in the comments down below. So as always, we will explore both sides of the argument and give you our conclusion right at the end. Now, the report starts with a somber note, where Daron, who's a professor at MIT, is skeptical about the impacts of generative AI. So he estimates that only a quarter of AI-exposed tasks will be cost-effective to automate within the next 10 years or so, implying that AI will impact less than 5% of all tasks, and forecasts that AI will increase US productivity by only a measly 0.5% and GDP growth by only 0.9%, cumulatively over the next decade. Joseph Briggs, on the other hand, which is a Goldman Sachs senior global economist, is a lot more optimistic. So he estimates that Gen AI will ultimately automate 25% of all work tasks and raise US productivity by 9% and GDP growth by 6.1% cumulatively. So while automating many AI-related tasks isn't cost-effective today, but similar to any advancement in the past, the cost of deployment will probably go down the curve over the long run. Now, another factor the MIT professor did not consider in his prediction model was to ignore the productivity gains from labor reallocation or creation of entirely new tasks or jobs, whether via displacement or through new task creations made possible by AI-related technology advancement. Historically, there is strong evidence to suggest that past economic growth stems from technological-driven reallocation of resources and expansion of the production frontier. In short, they basically create a lot more productivity from the existing workforce. And using census data, they found that 60% of workers today are employed in occupations that did not exist in the 1940s, and new occupations accounts for more than 85% of employment growth over the last 80 years. Sounds amazing, isn't it? Another concern voiced by Jim, the head of global research for Goldman Sachs, is the substantial cost to develop and run AI means that they must solve extremely complex and important problems for enterprises to earn an appropriate return on investment. So Goldman Sachs estimates that the AI infrastructure build-out will cost over $1 trillion in the next several years alone, which includes spending on data centers, utilities, and applications. So the crucial question would then be, what $1 trillion problem will AI be able to solve? So many people attempt to compare AI today to the early days of the internet, back in the 1990s. But even in its infancy, the internet was a low-cost technology solutions that enabled e-commerce to replace costly incumbent solutions. So overbuilding things the world doesn't have a use for or is not ready for typically ends very badly. So if you look at the Nasdaq, it declined around 70% between the highs of the dot-com boom. That said, one of the most important lessons that he has learned over the past 3 decades is that bubbles can take an extremely long time to burst. So with tech giants pledging nearly 100 billion US dollars in capex spending on AI this year alone, this is what we can observe, which was an insight drawn out by Cash and Gil, who is Goldman Sachs software equity research analyst. They found that Microsoft's Gen AI capex intensity is significantly outpacing the cloud build-out, with the ramp-up of Gen AI revenue also occurring at a much faster rate compared to Microsoft Azure. Despite being only roughly 1 year into its rollout, Microsoft's Gen AI capex efficiency is comparable to year 4 or even year 5 of the capex build-out of its cloud platform Azure, which became generally available in the mid-2010s. Now, after looking at so many different arguments from both sides of the aisle, the next question is, how should we play this crazy AI race? To share what Goldman hinted in the report itself, Jim, who is one of the more skeptical ones, said that he recommends remaining invested in AI infrastructure providers, because if his skeptical views proves incorrect, these companies will continue to benefit. But even if he is right, at least they will have generated substantial revenue from the team that may better position themselves to adapt and also evolve accordingly. So in short, heads you win, tails you don't lose much. On top of that, Goldman Sachs concluded, stating that the AI team continues to drive the US equity market to new all-time highs, with many AI beneficiaries experiencing large rallies. So while AI optimism has pushed valuation for many of the large tech stocks to elevated levels, the valuation of the largest 10 TMT stocks at 31 times pales in comparison to the peak of the tech bubble of 51 times and late 2021 at 43 times. More broadly, they believe that the AI team has much more room to run, with scope for its beneficiaries to broaden as investors look the next phase of this AI trade. For myself, I do share a similar opinion regarding the overall market valuation, not being in bubble territory. So will they go into a correction from here on? I honestly don't know. What I do know is that there are still plenty of companies out there that offer an attractive risk reward, even amongst the AI and technology names today. So do you share the same view as I do? This is CK from Piranha Profit signing off. Till next time, keep winning.